We've seen a repricing of assets in the consumer space around the direct-to-consumer strategy. A lot of investors have thought, well, this is a way to reprice a lot of the stocks, that you get a better multiple if you've got a D2C business. Nike's telling us it's not as profitable as it could be. Is there a warning sign here for stocks beyond Nike?
Well, we have to look at pricing power. Having pricing power for companies is very, very important. And if we look at the consumer sector, consumer discretionary luxury goods, where there is this pricing power, have tended to do better than consumer staples, where people have been really affected by the cost of living crisis, where it's been very difficult to put price increases through. So between the two, in terms of the consumer sector, luxury is a better pond to fish in.
We just heard from Kering this week that Gucci sales are going to be lower, that we're not seeing the same level of interest across the Asia-Pacific market as they thought. Is Kering a safe harbour? Is luxury a safe harbour anymore?
Yeah, we wouldn't be too negative. We know that China in particular is having some problems in terms of its economy, in terms of the propensity to save. Also in Japan, consumption has been relatively slow, but we still think that in the long term, without looking at some difficulties, in the short term, that there is some value in luxury stocks, and particularly if they retreat, that could be a good entry point.
Frédérique, there's so many lovely ideas you've given us in your notes as well. Let me just go, if I can, straight to the tech story, which I think actually dovetails quite nicely with our previous conversation about other places to look interesting. And you've been doing some work on the valuations now compared with, funnily enough, I was mentioning the turn of the century, compared with the turn of the century. How do they look?
We get a lot of questions from clients who are concerned about valuation levels and compare the sentiment we are having, we see around technology companies now compared to the tech bubble. And so we've looked at valuations, and there are a couple of differences. If we take the top 4 stocks during the stock bubble of the 1990s, these stocks on a trailing PE basis were on 80 times. Very, very high valued. And if you look at the S&P excluding those stocks, the S&P was on 23 times. Today, the top 7, the magnificent 7 that everyone refers to, on a trailing basis on 40 times, and the S&P excluding those on 21 times. Mm-hmm. So the tech sector, the leaders, are about half the valuation that they were at in the 1990s. And the big difference also is the quality of the companies. Today, the companies are managed by people with experience. The companies themselves have a huge track record in terms of profitability. Back then, as you remember, there was a lot of hype. Management was not always experienced, and a lot of these companies were very, very young and so not proven. So we don't want to dispute that valuations are elevated. The S&P excluding tech at 21 times is not cheap, but we're not at euphoric levels either.